Hello pawns! Did you know that only about 5% of all money exists as a physical cash printed by central banks? In America, it's printed by Federal Reserve. In the European Union, it's printed by European Central Bank. The remaining 95% are in digital form, created by commercial banks through fractional reserve banking system. So let's explain how the fractional reserve banking system works. Let's say John has $1,000 and deposits it in the bank. The bank writes $1,000 in his account as a promise. The bank keeps 10% of John's money as a reserve and lends the remaining 90% to Alex. Alex buys a motorcycle from Bob, and now Bob has $900. Bob deposits $900 in his bank. The bank writes $900 in his account as a promise. Then the bank keeps 10% of his money as a reserve and lends the remaining 90% to Michael. Michael pays Ariana $810 for one night, and now Ariana has $810. And this continues until the $1,000 becomes $10,000, but not in a single bank, rather across many banks, because not every depositor uses the same bank. And here is the trick. Let's say a bank has $50,000 in reserves. If depositors suddenly came and withdrew a total of $20,000, they would successfully withdraw it because there is enough money in reserve. But if all the people came at once and asked for $500,000, the bank would not be able to pay everyone, even though the bank wrote a promise in their accounts, because it only has $50,000 in reserves. This is called a bank run, and let's say the worst happens. The bank fails. What will happen to the 90% of people who didn't manage to withdraw their money from the bank? In the United States, there is an institution called the Federal Deposit Insurance Corporation, which insures deposits up to $250,000 per person. In the European Union, there is an institution called the Deposit Guarantee Scheme, which insures all deposits up to 100,000 euros per person. But if a person has, for example, $400,000 in one bank in the United States, the Federal Deposit Insurance Corporation will pay $250,000, and the remaining $150,000 is not guaranteed. Likewise, if a person has, for example, 200,000 euros in one bank in the European Union, the Deposit Guarantee Scheme will pay 100,000 euros, and the remaining 100,000 euros is not guaranteed. The most important questions: who benefits from the system, who loses, and how? If someone wants to deposit $1,000 in the bank gives him 1% interest on savings, takes $900 and gives it to someone else as a loan with 7% interest. The difference between the interest on the loan and the interest on savings is the bank's profit. But the problem for the depositor is that if inflation is, for example, 5% per year while the interest on savings is 1% per year, the difference between the inflation rate and the interest on savings is the loss of money, which means that his $1,000 is now worth $960. In this way, people pay a hidden tax without even knowing it. If you want more videos like this, please like and subscribe.